If you're feeling frustrated right now, if you're looking at your portfolio and seeing nothing but sideways chop and red candles on your favorite altcoins, I need you to listen to me very carefully. What you are witnessing is not the end of the bull market. This is not a sign of weakness. This is one of the most reliable, most historically proven setups in all of financial markets. This is the final, agonizing calm before an absolute storm of liquidity floods into crypto and sends assets like XRP, HBER, XLM, and SUI into a price discovery phase we have only dreamed of. Welcome back to the channel. In this video, we are going to connect the dots between a breaking jobs report, a trapped Federal Reserve, and the trillions of dollars sitting on the sidelines that are about to be forced into risk-on assets. This isn't hopium. This is a macroeconomic inevitability. Let's first diagnose the problem. Why is the altcoin market so painfully boring? Look at the data. XRP is trapped in a tight range around $2.80. XLM is dormant at 36 cents. HBAR is consolidating at 22 cents. There's no volatility, no volume spikes, just sheer exhaustion. The reason is not a lack of interest in crypto. The reason is a massive capital rotation. Money is flowing into what traditional finance sees as safe stores of value during times of economic uncertainty. The S&P 500 is making new all-time highs above 6,500. Gold is soaring. This is a classic risk-off rotation, but with a critical twist. This is the exact same playbook we saw in the first quarter of this year. Remember March? Gold was ripping, stocks were strong, and crypto was dead in the water. Commentators were declaring the bull run over. Then, April arrived. Crypto found a monumental bottom and proceeded to embark on a historic, multi-month rally that saw Bitcoin smash through $100,000 in altcoins like XRP print 500% gains from their lows. This boredom is a cycle. It's not a permanent state. It's the market's way of shaking out weak hands and consolidating before the next leg up. The boredom itself is a powerful bullish indicator for those who understand market psychology. So, what is the catalyst that breaks this boredom wide open? The answer lies with the Federal Reserve. In this past week, we received the single biggest piece of evidence that forces Jerome Powell's hand. On the surface, the August jobs report looked okay. The headline number was positive. But in economics, you must dig beneath the headline. And when you did, the report was an unmitigated disaster.
At this point, Senator Schmidt, is it wrong for Americans to think the Fed's decision-making here isn't about economics, it's about political sabotage?
100% it's about politics. Jerome Powell has discredited himself. You look, he was too slow when the Democrats were spending at record high levels when they were in power. He was too slow to raise rates, and now he's too slow to lower rates. Although the one time he did do it was right before the Democrats had that presidential election that they need to hold on to. That was the one time he did do it. So I think he's discredited himself and poisoned the well in many instances over the prospective effect of tariffs. The truth is, you have hundreds of billions of dollars now coming into the Treasury, which may cut into the deficit. You see now trillions of dollars being invested in production in new factories in this country that are not online yet. So I think the good news is all the key elements are being put on the runway right now. You've got the one big, beautiful bill with the tax cuts, no tax on tips, no tax on overtime, stability in the market because those tax cuts are now permanent, avoiding the largest tax increase. You've got these trade deals, which are going to be good for American businesses in our agricultural economy as new markets are opened up. So you're seeing the runway being set here. But the truth is, there's a lot of capital, Laura, on the sidelines because Jerome Powell has proven to be incompetent
The
once
rates
again.
are too high.
Here's the breakdown that every crypto investor needs to see. Part-time jobs, plus 597,000 full-time jobs, minus 357,000. Let that sink in. Every single net job created in the U.S. economy last month was a part-time, likely low-wage position. Meanwhile, the economy shed over 350,000 full-time, high-wage, career-oriented jobs. This is not a sign of a healthy, robust economy. This is a sign of an economy cracking under the pressure of high interest rates. Businesses are cutting back on their most significant expenses, their full-time employees. This weakness is compounded by real-time inflation data from platforms like Truflation, which shows inflation is already running below the Fed's 2% target. The Fed's two mandates are price stability and maximum employment. On the first mandate, they've won. Inflation is beaten. On the second mandate, the data is now screaming that employment is weakening rapidly. The Fed's last excuse that the labor market is too strong to cut has just evaporated. Jerome Powell and the Federal Reserve are now trapped. The political pressure is mounting exponentially. We saw senators openly accusing the Fed of political sabotage, stating that Powell was too slow to raise rates and is now too slow to cut them. This is no longer a quiet economic debate. It's a loud, public confrontation. The market has already made its decision. The CME FedWatch tool is the most accurate predictor of Fed policy, and it is now screaming one thing: cuts are coming. September FOMC meeting. In 11 days, 100% probability of a rate cut. It's a lock. The debate is only whether it will be 25 or 50 basis points. October meeting. Another 100% probability of a follow-up cut. December meeting. A very high likelihood of a third cut to end the year. This isn't a single event. This is the beginning of a full-blown rate-cutting cycle. The Fed is about to open the liquidity taps. And when they do, they rarely just turn them on for a month. This is a process that unfolds over quarters. Think about what this means. For over 2 years, money has been expensive. It's been hard to borrow. This has pushed a staggering amount of capital into safe, yield-bearing assets like money market funds, which now hold over $7.2 trillion. Rate cuts make holding that cash less attractive. They make borrowing cheaper. They incentivize risk-taking. They're the ultimate rocket fuel for speculative assets. Now, let's talk about the sequence of events. This liquidity doesn't hit all markets at once. It flows in a specific, predictable sequence, a liquidity waterfall. Stage 1. Equities, S&P 500, NASDAQ. The first wave of money always goes into the largest, most liquid markets. We're already seeing this. Stocks are at all-time highs. This is the smart money getting positioned early. Stage 2. Bitcoin. As equity markets get expensive, liquidity begins to trickle into the king of crypto. Bitcoin is the digital equivalent of gold for institutional portfolios. We saw this in Q2. A break above $114,000 for BTC will be the signal that this stage is accelerating. Stage 3. Ethereum and major layer 1s, SUI, etc. Once Bitcoin momentum is established, liquidity rotates into the blue-chip altcoins. Ethereum, as the lead of the altcoin pack, is the key here. Watch for ETH to break above $4,884 to confirm this rotation is underway. Stage 4. The altcoin explosion, XRP, XLM, HBR, etc. This is the final, most explosive stage. This is when the retail, crowd, and aggressive institutional money flood into the smaller, more volatile assets. This is where 5x, 10x, and 50x moves happen. This is alt season. Right now, we are in the transition between stage 1 and stage 2. The money is in equities, and it's just starting to test the waters in Bitcoin. The Fed's rate cuts are the trigger that will accelerate this entire process. So what is the game plan? How do we navigate this? Watch Bitcoin dominance. As long as BTC remains high above 57%, alts will struggle. We need to see this metric break down to confirm capital is rotating out of BTC and into alts. Identify key support levels. This boredom is your accumulation zone. For XRP, strong support sits at $2.60 to $2.75. For XLM, watch the 31 cents to 33 cents zone. For HBR, the critical level is 16 cents to 19 cents. Any wick down into these areas is a gift, not a disaster. Be patient. The weekly close is important, but the main event is the FOMC meeting on September 18th. That is the potential spark. Position yourself before the crowd realizes what's happening. Do not be shaken out by this boredom. This is the ultimate test of conviction. The fundamentals are stronger than they have ever been. We are standing at the edge of a macroeconomic paradigm shift. The era of expensive money is over. The era of free-flowing liquidity is about to begin. The weak jobs data wasn't bad news. It was the final key unlocking the door to the next leg of this bull run. The next 4 to 6 weeks will be the most important of this entire cycle. We have the Fed decision, we have the potential for the first XRP ETF approvals, and we have a market that is coiled like a spring, ready to explode. This is not the time for fear. This is the time for calculated, strategic confidence. If this analysis gives you clarity in a chaotic market, hit that like button and subscribe with notifications on. This week will be critical, and I'll be here breaking down every development. Follow me on Twitter for real-time updates. The storm is coming. Make sure you're ready. This is Crypto Usama. Thanks for watching. Stay smart and stay patient.